Welcome back, everyone, to my 3 stocks on sale series for the month of April. In each episode, I use all the current market volatility to find 3 new stocks that I think are on sale at today's prices for the long term. To make things a little more fun and interesting, I specifically choose one low risk, one medium risk, and one high risk option to show you a little more variety as well. As always, though, just please make sure to always do your own research and make your own decisions. I'm only sharing my personal opinion, and you should never make any kind of investment decision just based off of a YouTube video. Everyone knows that, right? Anyway, with that said, we got to kick things off here first with our low risk option. And you know what, guys? When we talk about some of the most dominant companies out there, relatively safer investments long term, everyone knows that right now Amazon is on sale, Google stock is on sale. But one stock that I think continues to be pretty heavily slept on is Disney, ticker symbol DIS. And look, I get it, Disney has become a bit more controversial in recent years, becoming much more political. Some people like that, some people hate that. And their quality for some of their shows and movies, at least in my opinion, has gone down recently. But looking at this just from purely a business and stock perspective, I feel that Disney is one of the few giant behemoths in media that is left out there with still some very strong and very high selling brands and IPs. And yet the stock is trading as if this company is absolute garbage, which I do not agree with. Because from the top now, you're talking about Disney stock here crumbling from a high of over $200 a share to now just less than $100 today. That's about a 55% crash, more than half its value lost. And I continue to say, guys, if you're thinking long term, in my opinion, anytime Disney trades less than 100, that's a screaming buy, because that's basically the lowest it gets looking at the past decade. It never really stays below this level for very long. So you've been warned, guys. Don't say I didn't alert you in the future. I mean, turn on your TV or go to the movie theaters and tell me how many giant shows and movies you're watching these days that don't come from this behemoth known as Disney, who already commands the most market share in the entire world and over a quarter of the US market as well. They're also the owners of 9 of the 10 best-selling movies of all time, 6 of the next 10, 7 of the next 10, 5 of the next 10, and 7 of the next 10 after that. So they just completely dominate the landscape. And on streaming, they continue to put out really popular shows from Star Wars like Kenobi, which even rivaled Stranger Things. There's The Mandalorian, which is an even more popular show, if you can believe it. And they still have upcoming shows like Ahsoka and more on the way too. Marvel isn't going anywhere either, guys. They put out a giant amount of content in Phase 4, and there's plenty more coming in Phase 5 and Phase 6. I agree that the quality has been going down, but if you think that they're going to stop making content for Marvel and Star Wars, you're crazy. Those brands are cash generating machines. And meanwhile, through Disney Plus combined with Hulu and ESPN Plus, Disney has already become the largest streaming company in the world after recently dethroning Netflix. And not only has Hulu become a great platform in its own right, but ESPN Plus is also experiencing a lot of growth thanks in large part to the partnership they have with the biggest MMA promotion in the world in the UFC. In fact, all the platforms have performed so well recently that returning legendary CEO Bob Iger is predicting profitability for the segment by next year, even though it's still very young, and he calls it his number one priority. And personally, I believe Iger can not only do that, but also get Disney as a whole back on track too. If there's anyone that can bring Disney back from the destruction caused by the pandemic, it's definitely Bob Iger. So with theme parks and resorts now opened back up, with streaming completely dominating the landscape and heading towards profitability next year, with Bob Iger at the helm of it all, with a return to growth, after a horrible couple years through the pandemic, that is now resulting in 20% positive EPS growth on average over the next 5 years versus negative 20% in the previous 5, which also leaves them with a dirt cheap price to earnings to growth ratio of just 1, which is almost 40% cheaper than the sector, and with a stock price that is just about as low as even the lowest price estimates from analysts. I would say that overall, as a Disney shareholder myself, there is a lot to be optimistic about here for the future. I get that the economy is still a mess. I get that Disney themselves have some controversies and other issues surrounding them, but the stock price is very cheap right now for what is a world leader in several very large markets. And so I don't lose any sleep holding on to and owning this stock myself. And again, I think anywhere under $100 is actually a solid buy for the long term. All right, guys, moving on to stock number 2. I usually pick a dividend stock for our medium risk option to help balance out some of that risk with a juicy dividend. And right now, I gotta say, guys, I don't know what's wrong with all of you. I don't know why you guys keep hating on my boy here, but the more that it crashes, the more I love it. And that stock is, of course, the medical device and surgical robotics company Medtronic, ticker symbol MDT. And like I said, I don't know why people dislike it so much. Over the past year, the stock has crashed by huge amounts, losing close to half its entire value, now down to a multi-year low. And it looks like it's even lower than the pandemic crash, which is definitely saying something. Valuation-wise, it's now trading about 20% cheaper than the sector on a forward PE basis, despite being their own market's leader as the #1 largest medical device seller in the world, even ahead of giant behemoths like Abbott Laboratories and Johnson & Johnson, and with a global footprint of more than 150 different countries worldwide as well. Just as important as the valuation, though, the stock crash has also raised their dividend to the highest level in history at well over 3%, which, by the way, that history is almost 5 decades in a row of consecutive increases. So this is almost a dividend king that we're talking about here, and yet investors are treating it like it's absolute garbage, with it also trading at about the same price as even the absolute lowest price targets from analysts. So it's almost as if Medtronic is in the worst bear case scenario right now. But is there any truth to that? Is Medtronic as a company really becoming like a complete failure? Of course not. This is a giant behemoth that will likely always be around with billions in sales and profits every year. Now, granted, sales are dipping this year by a small amount before they get back on track to around mid-single digit growth, just like they did in 2020, which, by the way, was a horrible environment for them because more hospitals were literally going bankrupt than any other time in history, as people were either on lockdown or just staying home and avoiding hospital visits because they were afraid that people might be infected there. So they delayed surgeries and procedures that Medtronic relies very heavily on for their sales. So with a record number of bankruptcies, obviously the hospitals are not going to be able to buy the products that Medtronic sells. And yet revenue only dipped about 5%. That's incredible. And now you're talking about a 2% dip this year. Well, okay, China continued their lockdown policies, and now you're seeing their hospitals go bankrupt too. And over the past year, we still saw an 84% increase in healthcare bankruptcies, bringing us back to 2020 levels. So how in the world is Medtronic supposed to grow in this environment? Obviously, you're going to see a dip here. That shouldn't be a shock to anyone. And to make matters worse, the pandemic supply chain issues that have plagued the entire world these past couple years have obviously taken a toll on the world's biggest medical device leader. Obviously, it's going to take a toll on them, which also caused them to delay the launch of their brand new surgical robotic system that they were explicitly relying on for growth in the first place, since that's a market that is expected to reach nearly $100 billion soon. So everyone wants to sell out of this stock. I get it. I understand at least some of that crashing for sure. I mean, if a company's market is deteriorating because the economy and the environment that they operate in is really bad and it's hurting their sales and profits, at least in the short term, then obviously Wall Street is going to sell out of that stock and it's going to go down. That's perfectly logical. What does not make sense to me, though, is to the extent that Wall Street is crashing this stock to the point where you have a world leader here that is yet trading for a valuation that is even cheaper than the sector, and you have essentially a dividend king with a dividend that is at the highest levels that it's ever been. That's got to be a buy here, especially if I believe in the company, which I do believe in Medtronic. So that's fine. People can keep crashing the stock, but I happen to like it. And sure, it'll probably go lower from here because the economy is not looking like it's getting better, at least here in the short term. But even if the stock price goes lower, that just means an even cheaper valuation, an even larger dividend. What's not to like about that? So I'm invested in Medtronic. It's one of my favorites, I think, this year. All right, guys, enough ranting from me on Medtronic. It's time to finish up here with the final stock, stock number 3. This will be our highest risk option. And this month, you know what, guys? I'm going with the fintech SoFi, ticker symbol SOFI, because in my opinion, they're being brought down right now by something that I believe is overblown in the case of SoFi specifically, and that's the financial collapse of Silicon Valley Bank and a couple other regional banks during this horrible economy. And so you saw banks like SVB and Signature Bank collapse, which, by the way, are the second and third largest bank failures in history, worth over $300 billion in assets. And because of that, you saw financial stocks crashing left and right, which SoFi was not immune to either, falling over 15% just in March alone. And despite still being up over 20% so far this year, it's actually down a whopping more than 80% from the top. So this is by all accounts a heavily beaten down stock here that we're talking about. And look, we talk pretty often about the reasons why I like SoFi so much, so I won't spend much time on that. I mean, I've already told you guys that I see this as a very disruptive fintech with a robust all-in-one platform for investing, lending, financing, banking, basically anything you need for all your finance needs. They've had huge growth with less than 1 million users in 2019, now up to over 5 million this past year, and they acquired Galileo, gives them access to more than 130 million more user accounts that they can market to as well. And yet there's still so much future potential given that their addressable market is already estimated to be worth over $2 trillion today, which is about 400 times larger than all the sales they did last year, which is why they've been able to grow their sales by such large amounts every year, with even the disastrous 2020 still seeing revenue growth of almost 30%, another 70% growth in 2021, and over 50% in 2022 at a time when federal student loans have been paused, which is a giant part of their business, and yet they're still putting up growth of around 30% right now, even with how disastrous the economy is, and especially in the scary finance sector right now. And so for today's video, instead of all of that, I just want to quickly explain why I feel that the collapse of SVB is not similar at all to the position that SoFi is in, and it doesn't really impact the future potential that I believe they still have. First of all, SVB only had 5% of accounts insured according to Bloomberg, while SoFi is the complete opposite at over 90% insured, meaning that if there was a bank run, way more people would panic under SVB and need to withdraw their funds in fear of losing them, whereas under SoFi, you wouldn't see the same level of panic because their deposits are smaller in size and mostly insured, at least in most cases. SVB was also heavily invested in long-dated bonds marked as either AFS or HTM, which accounted for close to 50% of their total assets, while SoFi only held just about 1%. And when interest rates go up, those long duration bonds get heavily damaged. So if you have a bank run and need to immediately sell these assets for a loss instead of holding on to them until maturity, then you end up with a complete disaster, and that's what happened to SVB. And while SoFi is still a very risky stock to own, just like any other financial stock during a weak economy that may be headed for recession, it's not going to be immune to that, and especially considering that SoFi is not currently GAAP profitable yet, I still just feel that for me personally, not saying for you guys, but for me, it's worth buying a very small amount of the stock as a speculative bet for the long term, because I see so much growth potential for the future on a stock that is only trading for a price to sales ratio of less than 3, which is down from over 20 less than a year ago. And that is actually quite profitable on an adjusted basis as well, growing at a very large rate too, making it only a matter of time before SoFi transitions from being a speculative stock over to something that I consider to be an actual investment, at least in my opinion. And that's why I'm choosing to buy it. Again, though, in very small amounts because it is still very high risk. But that's okay. That's the whole point of this video. I choose one low risk, one medium risk, and one high risk stock. And this falls into that high risk category. By the way, the CEO of SoFi actually bought close to $1 million worth of the stock when it fell because of the whole SVB collapse. And I'm not saying that never makes a stock a buy just because management is buying it, but it is something that you like to see because it does show at least a sign of confidence from management if they're investing in their own company. Anyway, That's going to do it for this month's episode. Let me know what you think about these three stocks. Let me know if there are any other stocks that you guys are buying out there. I may include it in a future video and talk about it and give my thoughts on it as well. So always drop your comments down below. I read all of them. Sometimes I don't have enough time to respond to every comment, but I always try to read it, at least read every single comment. So thank you for stopping by. Thank you for all the support. And it really means a lot to me. And I will catch you in the next video, my friends. Hope you're all doing well. I'll see you next time. Bye-bye.